So we just picked up some activity here where someone was selling puts, which is a bullish position. They put $1 million at risk and they look to make 8% on capital if they're right in the next 30 days. My name is Joshua Bellinger and this is another Follow the Money. So today we're looking at ADI and this is Analog Devices here. And right now we closed at 123. The activity that we saw was put selling, which is a bullish position in the options market, this bullish positioning. By selling puts the open, and they're looking at this 110 strike. This is where it was initiated. So what they're looking at in this position, which would be bullish, is that they're looking for prices to stay within this range. And during that time, if time eats away, that premium that they sold will decrease, and that what they sold at, they could buy it back cheaper and take that profit. So let's take a look here at the option montage. And this is the activity that we're talking about here at the 110 strike. They sold these at 110 per contract. So times 100 times 10,000 equals about $1 million that they took in on here. Now they have risk on this position from 110 below. So they took in a dollar, so it's 109 below. That's where they start to have risk if something happens here. But what they're looking at is the probabilities. This has a probability of 85% expiring in the next 31 days out of the money. And that probability there, that's what they're looking at. They're playing probabilities, but that's a big amount of money to put at risk when you have a lot of volatility that could come up in the financial markets. But it just shows you that no matter the volatility, they think prices are either going to stay in this range or go higher here. So return on capital in the next 31 days on that is 8.5% or 8.56%. So, you know, putting that up there, they get $1 million that are taking it in. I imagine that they would be looking to take profits on this and buying these profits back, rolling the position potentially in the next, I would say in the next 15 days, 21 days, somewhere around there. They wouldn't let this go into expiration because it's too much risk on there. So they would be looking to manage this probably around 40 cents, buying them back and probably rolling into December or January, potentially, if they're looking to continue this position here. But this is interesting activity because this is big money putting on a position, and this is the interesting activity here. Now, how do you simulate this? Well, if you want to find risk, because this is a $110 stock, you could look to do something where you sell the 113, 110 spread. So you're looking at about 60 cents there, 113, 110. You take 60 cents minus the 3 points on there, so about $2.40 of risk. But you take 60 cents in, and again, at the 113 strike, you have about an 80% probability that that expires. Now, you wouldn't want to let this expire worthless at 60 cents. That's the big mistake here. You would want to manage this, take this off around 20 cents potentially, and take the risk off. But again, that's the opportunity here. If you're following along this activity, it's interesting to you, that's how to play it. You can also look to play calls, but again, they could be looking here to see where prices just kind of drift around and the decay kicks in, and decay is in their favor. They buy them back, roll them over. But again, that's the election cycle here. They're looking for this to kind of stay in that range. So keep an eye on this one, and I'll see you in the next edition.